Yeah, so back in around summer, autumn of 2018, I turned pretty bullish on gold and silver, and so we added the gold, the silver, and some of the miners as well. And so over that time, those have done very well. And I think until it kind of breaks below that, it's hard to get kind of a really good move on gold and silver because rate of change terms is not getting worse. One thing I've been watching even prior to this pandemic was that GDP growth was declining in rate of change terms. So we were getting GDP was still going up, but it was slowing compared to where it was in prior years. The virus comes along, and then that would have been kind of easier for the world economy to deal with if it wasn't for the fact that there's so much leverage in the system, both in corporate balance sheets, household balance sheets, and then even on sovereign balance sheets. Whereas silver is a weird hybrid because it's not like copper or oil where they're pretty much purely for industrial use, but it's not like gold where it's almost entirely for wealth and storing and displaying wealth. It also has a stock to flow ratio, which is not nearly as high as gold, but it's way higher than pure industrial ones like copper or oil. And so it's kind of got that hybrid status. So I'm pretty neutral for about 6 months, and I still remain long-term bullish. And the key variable to watch is actually real yields. And so if you look at gold compared to the 10-year treasury minus the prevailing inflation rate, but because gold is largely financialized, it tends to follow the 10-year treasury minus the official CPI. Or you can use the treasury break-even rate. So it's what the TIPS market is pricing in as their inflation expectations. Yeah, so back in around summer, autumn of 2018, I turned pretty bullish on gold and silver, and so we added the gold, the silver, and some of the miners as well. And so over that time, those have done very well. And we're kind of currently in a consolidation, right? Because we at last month or so, the prices went up pretty fast, pretty quickly. And so in some ways, they kind of reached overbought conditions in the near term. So I wasn't be surprised to see a pullback. And so a general trend you see is that you can't monitor it in the same way that you do gold. But generally, when gold is in a bull market, usually silver is doing better. When gold's doing very strongly, especially if you have gold rising due to disinflationary conditions, right? So like we had from say 2018 to 2020, we had inflation levels were going down because global growth was slowing, but then nominal treasury yields were going down even more. And so that's a disinflationary period of that gold benefited from, whereas silver did pretty poor. Now, ever since we came out of that March 2020 bottom, silver did better than gold because that's a more inflationary environment. We have a very sharp increase in the broad money supply. We had rising inflation expectations, and so if you track gold next to real yields, it actually aligns inversely very closely. And so gold's actually doing what I'd expect it to do during this period when real yields are kind of chopping along sideways. And so what we saw from, during that big gold bull market from mid-2018 all the way up to mid-2020, you saw real yields collapse. And so real yields went from like positive 1% and they fell all the way down to like negative 1.08%, but based on that measure. And then from there, because the 10-year treasury started rising, so the 10-year nominal yield started rising, roughly, a little bit faster than the official inflation rate, you actually started to get kind of a, no longer deterioration on the negative real yields part. So they went up to like, negative 0.7, which is funny because it's still negative, but it's higher than its rate of change. So it's higher than it was at negative 1.08%. So if you look what happened in March, for example, we had that big deflationary shock. We had a decline in the gold price. And it was interesting because there was a big divergence between the price of physical gold and silver and the price of ETFs and futures and other kind of more paper products. So if you were trying to buy gold and silver during that sell-off physically, you couldn't really find it in most places. And if you could, it was way higher. So actually physical kind of coins went up in price, even though if you're looking at the ETFs or the futures, it took a pretty big dip, especially silver. It was actually a really good buying opportunity. And then when we had that kind of policy response, so they started to kind of expand the money supply and kind of throw money at the problem, then of course you had gold and silver and the miners explode back up, right? Because they never really should have been down there in the first place. That's what happens in liquidity shocks, is people kind of sell whatever they can, including their gold and silver, just to get cash to meet margin calls and other things like that. So for people that are unleveraged and they can kind of wait that out, that was a very good buying opportunity and holding opportunity to kind of wait for that rebound. And I think until it kind of breaks below that, it's hard to get kind of a really good move on gold and silver because rate of change terms is not getting worse. The big question I think to watch out for is to go back to some of the things we talked about earlier, which is the yield curve control. Because as long as you get an environment where inflation's rising and yields are rising to compensate for that, then that kind of keeps gold in check. The scenario where gold totally explodes is if you get, say, yield curve control, or just for whatever reason, treasury yields stop keeping up with that inflation, and then you push back, well below -1% real yields. That's when gold can explode upwards. And I think it's possible we could repeat another one of those events to some extent if we get kind of another kind of solvency event. I wouldn't be surprised to see kind of consolidation or pullbacks in some of the precious metals temporarily. And I would view that as another buying opportunity. I think physical is great to hold where possible. There's also kind of funds and miners you can get to get exposure. Longer term, I think that likely gold and silver are still kind of going to do pretty well because I don't see this expansion of the monetary base kind of ending anytime soon. I think they're going to probably run very large deficits. A lot of it will be monetized, and we're probably going to have negative real rates for a while. Yield curve control would definitely do that. And the other snare would just be that, soft yield curve control. So the Fed's buying a lot of treasuries, the treasury market just doesn't keep going higher, and then you get an inflation spike and the treasury market doesn't keep up. And then that'd be kind of like the 70s scenario, because there was no yield curve control in the 70s, and yet you still had those spikes to negative real yields. So either of those two options can occur in order to get a big blow off top and a big kind of sharp, upwards valuation in gold and silver. I've kind of been tracking the money supply growth. So over the past month, because we've had kind of that fiscal gridlock, we've actually, money supply growth was increasing very quickly earlier in the year, and the past month or so, it's been kind of static. So if we have one of these more deflationary shocks, I wouldn't be surprised to see the pullback. But I think longer term, we're going to see the money supply continue to ramp up pretty quickly. And so I think gold and silver are pretty good ways to hold your purchasing power, at least as part of a diversified portfolio. I mean, it's not the only thing I'd want to hold, but I expect over the next several years, I think we're still in the first half of this run. So I think, pretty much regardless of where I was in the world, I'd want to have a pretty good amount of gold and silver exposure, and then exposure to some of the miners as well, because that can give you a little bit more upside potential if you're willing to kind of stomach that volatility. So I think, in many ways, they've already been doing soft yield curve control, which is why we're at -1% or so. And so the fact that the Federal Reserve has been the biggest buyer of treasuries in many ways makes them kind of doing de facto yield curve control. And if you look at different measures, like where the 10-year yield should be at this point, if you look at, for example, compared to it historically follows the copper to gold ratio pretty closely, or, I mean, normally the 10-year treasury is higher than the inflation rate. And so this has actually been a pretty usual period where it's actually very low. It's at -1%, the real yield. And so they're already doing soft yield curve control. The question is whether or not they'll be able to keep doing that while you get an inflation spike. And even if you look at, some of their prices, like GDX, the ETF for gold miners, fell more than the broad stock market did in March. So it went down dramatically. It was just like an incredible buying opportunity. And so, we've had a sharp rebound then. So if we have kind of another kind of one of those scary moments, I think I personally would view that as another good buying opportunity. So I think long term, I still think we have kind of a pretty good upside potential here. And so silver, being a more inflationary metal generally, as it's both, it's a more speculative metal because it's higher volatility. It's also used in industry, and so it did very well in that environment. I look at things like the gold to silver ratio. I consider things like inflation levels, and so I like diversifying to silver. Overall, I'd expect, if gold does well in the 2020s, I wouldn't be surprised to see silver do better. You can't track it next to broad money supply and real interest rates. It doesn't really have that tight correlation that something like gold has, because it's not a pure currency in a sense. I don't really use specific price targets because it partially depends on what happens with fiscal spending. But I still think that the kind of the end of this run is probably going to be notably higher than now. Whereas silver is a weird hybrid because it's not like copper or oil where they're pretty much purely for industrial use. And so if you track gold next to real yields, it actually aligns inversely very closely. It's hard to get kind of a really good move on gold and silver because rate of change terms is not getting worse. In order sort of get a big blow off top and a big kind of sharp, upwards valuation in gold and silver.